Good afternoon, everyone. My name is Linda Knowlton. I'm the Vice President of FAMP, and I am joined today with Gino Morrow, the FAMP President, and Roy DeLoach, NAM Lobbyist. We thank you for attending FAMP's webinar today. We hope that you and your families are healthy and safe. As we navigate through our industry today, FAMP is providing information almost daily through webinars and informational emails. As a mortgage professional, we hope you support our industry trade group that protects your livelihood and brings you educational opportunities. If you are an FAMP member, we thank you for supporting your industry. If you are not a member, please support your industry and join FAMP today. During this webinar, should you have any questions, please type them in and we will have an opportunity to ask those prior to the end of the webinar. It is my great pleasure to introduce our speakers today. First of all, Gino Morrow. He's the president of the Florida Association of Mortgage Professionals, FAMP, and he also serves as council member of the Broward Housing Council. He has over 20 years of experience in this financial industry and has been an educator in both the mortgage pre-licensing education for Florida, as well as in the reverse mortgage industry. He uses that experience to help his community. I have had the pleasure to work along Gino for the past 3 years, and I think I talk to Gino more than I speak to my children daily. So you are in for a treat. He is a great guy. Our second speaker, Roy DeLoach. He is a Washington, D.C. based attorney and lobbyist with more than 20 years of legislative and regulatory experience in the financial services sector and related industries. He has a particularly extensive background in a number of issues related to housing finance, including mortgage loan origination, loan servicing, and secondary market transaction. DeLoach has served as a chief executive officer of major mortgage-related trade groups. He has also worked as a lobbyist for several trade groups and currently is the lobbyist for the National Association of Mortgage Brokers. Again, it is my extreme pleasure to introduce these two, and Gino, take it away.
Thank you, Linda, and happy Friday to everyone, and thank you for joining us today. Linda will also be collecting your questions that you can type into the chat box throughout the presentation, and as time permits, we'll try to answer as many of those questions as we can at the end of the presentation. As a quick reminder, I just want to let everyone know that if you are an FAMP member, you will receive a recording of this webinar at some point today. And if you're not an FAMP member, please join us so we can continue to protect our industry and our members. We also have a lot of members-only content available on our website, including a full library of this webinar information series that we've been providing. Especially during this pandemic, there's tremendous information there. And for those of you who have not heard Roy DeLoach speak before, I am so glad you're on this call today. Not only is he a great advocate for our industry, but he is just a genuinely nice guy. So I want to thank you so much for spending the time with us today, Roy.
No problem. It's my pleasure.
Now, as you know, because we did very similar to other states, but at the beginning of this pandemic, I signed a letter that was sent to Governor DeSantis about the essential business and the industry, just as other governors and other states had done. Do you think this was impactful? Did it help?
Yes, very much so. What we were worried about early on was like who's essential, and that decision making is very iffy, especially if you're having it done by somebody in Washington, D.C., because they really don't know, how the whole mortgage process works. So if a lender is essential, but processors are not, or a title person or something, then the entire mortgage system sort of freezes up. We had to make sure that everybody knew the complexities of the mortgage system and how many different people have to touch that mortgage. And so we sent a letter. I think a lot of states sent a letter, and then some states that NAM worked with, we helped them send a letter as well. But that is important because I think that letter sort of triggered the CFPB actually calling me or NAM and saying, hey, could you guys get on a phone call because we need to know exactly what to, watch out for when they make policy at the CFPB level, and then the recommendations they made to Congress. And so that call occurred. It was actually 2 calls, and we had, Kimber White, who everybody I think knows in Florida, was the past FAMP president. He was on the call because he is NAM president-elect. So he was there, and we went through the definitions of why, who needs to be determined to be essential. We talked about that. We talked about, the problems. So we sort of anticipated some problems with the 3% mortgage cap in the QM space, and sort of planted some seeds with the CFPB so that we could start talking about how, some of these loans coming down in the future were going to be problematic for mortgage broker pricing. And sure enough, that was pressing it, because we can talk about that later. So that's happening probably right now. We also delved into just the litigation exposure, not only between the realtors and the mortgage broker or loan originator sitting across from a consumer. Then how do you do the appraisal? So all these things, started cropping up, and I think a lot of agencies took actions, especially Freddie Mac and Fannie Mae and FHA, changing their appraisal requirements to fit these, to fit this pandemic. And so those are very important things. And so sending the letter was impactful, because you get called, when you participate in Washington, and you surprise people like, hey, I didn't know anything about how complex the mortgage process was. You start getting phone calls from agencies and people on the Hill. So there, it was very important that that you sent that letter, and thank you again.
Thank you, Roy. And we're going to move on to the CARES Act. And in the CARES Act, they refer to deferred mortgage payments and forbearance. And we just wanted a suggestion on how our FAMP members can discuss this with their clients, and what can benefit our industry best.
Oh, sure. Now this will take a long time, so everybody just try to hang in there, but because it's really twofold. Number one, first thing we were worried about was, okay, so there's a forbearance possibility, and I won't go into is it 3 months or 6 months or 12 months? There's a bunch of examples out there. What we're worried about was, what impact this would have on your customer base after this is, settles down. Is it going to impact the refinance? Is it going to be a problem for them for purchasing a home? So we send out a notice to our member, to I think everybody, Florida and nationwide, that said, hey, first of all, tell your customer base, if you can make your mortgage payment, please do, because we don't know exactly how this is going to impact consumers downstream. And sure enough, what's happening is what we're already seeing, some of the consumers that did request forbearance, there are things that are showing up on their credit report. It doesn't show that they're missing a payment, which they would get in trouble for, but it is showing, there is one report that's like they have a line in there that says loan impacted by national emergency. And so what we're worried about is just even that line right there could hurt consumers, your customer base, in the future. So there will probably be, and I just reread the statute, CARES Act, and I believe that just that statement like that could hurt or could put the credit bureaus that report it like that into a little bit of hot water, because it's not exactly what it was intended to say in the CARES Act. It was basically there should be no impact on the consumer credit report, and I consider that an impact because at the end of the day, that loan is is being paid for. Is the principal and interest are being paid. The other leg to that is, in some states, the taxes and insurance, let's say New York or New Jersey, it's as much or more than the P&I. And so those states or those consumers are going to have an issue there. Is like, yeah, you don't have to pay your P&I, but you got to pay your other part of that mortgage payment. And so again, that's going to impact your consumers. And so we sent that out. And so what was happening about a week and a half, 2 weeks ago, there was a problem with how how the broker price sheets were working. Not just the broker price sheets, but basically all the lender sheets were showing that there was this problem of closing a loan, getting it ready to go to Ginnie Mae, and then having the consumer ask for a deferment within a couple of months of that. And then what would happen to that loan? Does that trigger something? Is that an early payoff, early default, or how do you describe that? And so that market started freezing up, and then all of a sudden, the Ginnie Mae, the leaders at Ginnie Mae decided, no, we're not going to let that happen. So in the FHA, VA, USDA world, that letter came out from Ginnie Mae, and that's sort of like, okay, well, everybody does those type of loans knows that they can send that back into Ginnie and it'll be purchased, even if the consumer has selected deferment. So that's the easy part. The hard part was when someone was asking the GSEs, well, what are you guys going to do? And how does this impact the servicers on that side? Because just because a consumer doesn't make their payment, I think you all know, and the servicer is required to. And so what it led to was a situation where I saw a percentage this morning, and I think it's approaching 5% of the mortgages out there are asking for deferment. And that's a big number. So when these servicers get that request, and it gets caught up, because at the end of the day, Freddie Mac and Fannie Mae actually own all these things. It's just the servicers having a function in the market. So that part was starting to freeze up. And then we in town, we were working with the GSEs and FHFA and Mark Calabria and the Treasury and the Federal Reserve Board, and trying to figure out, well, what's going to happen here? Because number one, during the CARES Act debate, we saw there's going to be a lot of deferments, and then there was a lot of debate about, well, the Federal Reserve Board should open up basically a cash window for non-bank servicers. And so that part of the debate did not get into the CARES Act, and so that sort of was the first part of the problem. And then what was going on then is the same thing. It was like the pricing was getting, no one really wanted to get into the loans, or they were raising. I think everybody probably saw where everybody was moving it from in the 600s to the whatever. It was probably the 720, 700, 720, and 20% down. I forget who. I think it was Bank of America or Wells, or no, it was Chase. I apologize. Came up with that 700 and 20% down, etc. And so you saw the same thing that was happening in the Ginnie Mae world happen over here in the conventional. A lot of pressure went on, a lot of debate, and so everybody was very, very excited. It was Monday or Tuesday this week. We thought we'd have like a really great solution out of FHFA and the GSEs. Number one, because they do have access to a lot of money. So they do have the GSEs have access to over $200 billion over at the Treasury. It's just basically a line of credit just sitting there they can use to make up for these shortfalls for what didn't make it into the CARES Act. They had to come out with something. It was basically, sure, the GSEs can purchase these. Now you probably read this, but I'll just lightly touch it, and then we can move on, because I don't want to take up the entire time frame with this, because I know there'll be questions. And it was basically, if there's a first-time home buyer, it's going to be 500 basis points added, just in case that loan went into deferment. in the case of a new purchase, it was 700 basis points. There was no cash out refinances that the GSEs wanted to hold. And then there was other issues about the servicers have to make the payments for 4 months, et cetera. So the bottom line is this just doesn't work for non-bank lenders and servicers. It's just that's where the market started seizing up around Tuesday, Wednesday. And then the pushback we had is it's just really not fair to the market because Ginnie Mae sort of stepped up and cleaned their situation up. And on the conventional side, the issue really swirls around the fact that if you're a bank, you're allowed to go to the Federal Reserve Board and more or less get money to cover your issues you have with the CARES Act deferral issues. So
right.
we're basically went to the Hill and we wrote a letter to Steve Mnuchin at the Treasury and Mark Calabria and the Federal Reserve Boards, sort of outlining all these problems. That obviously, I think every trade group in the mortgage world did that, and then we get this result, which really is not that much of a result or a good ending to this problem. So what we did next is we, said, look, we need a call to action straight to Congress because Congress created the deferral program inside CARES Act. That was just the part that wasn't taken care of was the servicing side of it. And I appreciate, because I know that's gone out and there's been 8,000 letters and emails sent to Congress over the past 2 or 3 days. So, and I know that Florida has really jumped in on that and pushed that out. And so it's really important for everybody, even though you think I'm just a small business mortgage broker company or I'm an LO wherever, it's very important to jump on these calls to action because all of our voices collectively across the country, and then we were working with the small independent or IMB, the small mortgage bankers, to try to help have their, because at the end of the day, you don't want 10 banks controlling the entire mortgage system. That's just not going to be good for mortgage brokers. And so we went out there and started helping the independent mortgage bankers with this problem as well. So thank you everybody that did participate in that call to action. So we hope that Congress will see fit in the next few weeks to put some legislation together that will fix this problem. There is a rumor running around Washington, and that's one of the things about Washington is that you sort of discount by every rumor 50%. But there was a rumor that the Federal Reserve Board was or trying to work on a lending facility for the non-banks sector, and they were trying to shoot for the middle of next month. So the bottom line is when we sort of read the tea leaves because FHFA, Mark Calabria, has no interest in changing what his agency came out with on Monday, so they're not going to change that. And then Steve Mnuchin just said, the Treasurer Secretary said today, said he does not see a problem in the mortgage market just yet, and so is not willing to step in. So that's kind of like a signal that our solution as mortgage brokers is either going to come out of the Congress or this sort of rumor that the Federal Reserve Board will try to make a cash window for non-bank servicers and lenders. So that is that's sort of like the quick overview of that servicing problem and the CARES Act and deferrals and who's going to make the payment instead of the consumer. So, and I think that what we need to make sure what was very helpful, and I think it should be, if you need direction to it, Linda and Gino can point you, but the NAM did send out our letter to all of our members But the CFPB has a great video that sort of explains this. And if you have that, if you have access to that, it's very helpful just to take that clip and send it to your borrowers, because the first thing that the CFPB says, if you can make your mortgage payment, please make it, because it's going to be helpful downstream, not only for the people that really, really need their mortgage deferred, but it just you can't just have it's sort of like everybody rushing to the hospital to get a ventilator. You can't have everybody rushing to the government and offloading their mortgage payments, because that's going to be a huge check to write. So anyway, that I thought was a very good piece of video coming out of the CFPB. So please take a look at that. Just a couple of follow-on issues that fall out of this is there's like I call it the domino effect. Once you start something in Washington and you don't have someone that can implement corrections and changes and help out the industry, things start falling apart. So one of the a couple of them were, you probably know this, the 4506T problem. When we spoke to, which basically the IRS says, oh, we can't do it because it's, bottom line is the unions up here don't want, people in an office trying to, work on this and then catching something. So the negotiations went on, and I think that facility will open up. I think it's actually in West Virginia. So they're going to space everybody out, excuse me, whatever, 6 or 15 feet apart, and try to get that 4506T operation back up to speed. But I think that the lenders sort of found a workaround for that, at least temporarily. And the last one, the most interesting one I was working on, is the credit reporting disputes. So just think about it. If a consumer goes and asks for something to be corrected on their credit report, there are time frames that the people have to respond to, either no, it's a real debt, or no, I'll take it off.
Right.
Congress didn't do anything about those time frames. So if you have a lot of people that aren't working, that don't have call center operations, you can't go on to the courthouse or whatever and find out things. There's this whole industry popping up of getting things off of consumers' credit bureau or credit reports. So it's one of those things where when it starts to rain, it really pours about the complexity of the mortgage industry. So I know that was long-winded, but I thought the most important thing we're doing right now, and we are doing a call to action on it, please, as I said, it's important for us to get that conventional GSE, Freddie Mac, Fannie Mae product to flow again in the non-bank system, in the non-bank arena.
Yep.
Okay.
Thank you. And it's always interesting to hear you talk about this, because doing what you do, you get to really walk us through the process, and you really get to see how this happened and the opinions of different people involved in this throughout the decision-making process and the impacts. And this has absolutely given everyone in our industry a reason to communicate with their borrowers. At the very least, it's given us an excuse to make that phone call and keep that relationship going. And a lot of what we do, from what I'm seeing, is very impactful. We're certainly going to be supporting the call to action and get that out to our members, and that CFPB video you talked about is something we have shared, and it's a great idea to get that out to your clients and to your borrowers. So definitely some great information, but I love to hear your point of view on how these actually happened. It's really interesting to talk to you all the time about this. Now that brings us into, and it's a good transition, but broker pricing. And I know this is kind of a up in the air right now, but when do you think we'll start to see it normalize? It's been a bit all over the place.
Well, I thought before I saw what the FHFA put out in terms of the 500 basis point, 700 basis point piece, I thought it was going to normalize this week and maybe a little bit into next week. But once I saw that, I go like, okay, well, because I go on, believe it or not, I do go see these, I'm able to go look at pricing sheets, and if you're a broker, you're basically pretty much priced out unless you want to work for free of these markets. So I think that in summary, obviously the Ginnie world, the Ginnie products, that's going to be too bad of a situation if you can fit your borrower in that area. But I think in the next 2 weeks that this whole problem with the GSEs and having access to liquidity, I think that's going to clear up. And so, but I think there are some lenders out there already anticipating a fix and are trying to basically price in now or normalize their pricing, depending on how large they are, and depending on, if you're unfortunately, if you're a smaller lender and you have a warehouse line and you have a lot of problem getting your product on and off quick enough, I just think that's the biggest worry we have is the smaller lenders. If they die off or they're impacted, that just is not helpful to mortgage brokers. So we're trying to push to try to get this facility up and running as fast as possible. But the answer, I think, unfortunately, for some of these pricings is probably going to be about 2 to 3 weeks from now, because what'll happen is somebody will announce the non-bank fix that's really a fix, and then it'll take them about a week to roll it out. And in Washington, there's everybody says they want to do something, but then when you really dig down, you have to get a bunch of lawyers around a big conference table to try to figure out how to write how to write these agreements all up. And so my gut tells me there's a bunch of lawyers probably on Zoom yelling at each other right about now,
Right.
trying to figure out how to write these contracts and these agreements.
I imagine you're right. The good news is we are starting to see some confidence in the industry, and we are starting to see some of the lenders reestablish, less stringent lock policies, and so we are definitely starting to see some movement back towards normalization. So it's we can definitely see that across the board. The next question I have, and this is something that's been coming up a lot. We're getting a lot of questions on this, and this is with regard to the SBA loans. I know, there's just been some major change here on that, but if you could talk to us a little bit about, whether our small to mid-sized brokerage businesses should be applying for these. Love to hear that.
No. Yeah, that's another area where, Florida actually was very important, because I don't know, a lot of people don't know that Senator Rubio is chairman of the Senate Small Business Committee. So that was very helpful to us, because we did utilize that office to try to clarify a few things. So SBA, the Small Business Administration, they have already rules and regs on their books today. And this is why it's important to, join your state association, join your national, because you have to, you have to show up in Washington to protect your interests. And this is what was going on, is when you looked at the SBA rules, it actually had, if you're involved with lending, you could not get an SBA loan. And then it said, oh, and by the way, if you're a loan packager, you couldn't get an SBA loan. And so they're going like, well, that means brokers. So we're going like, oh, well, lenders and brokers can't get an SBA loan to protect their business. And we, that took us about a week before the SBA the SBA regs came out to sort of clear that up, as that, that we were not in that sense of the SBA's regs. A loan packager is someone that packages up SBA loans and sells them, and it wasn't mortgage broker. So you could argue, I guess, is what they were arguing, is like, well, you guys package loans, and so you're out. So it took us a little while, and then we did go back inside the CARES Act, and there is because we thought most everybody was covered, except if you're a real bank or some companies. I'd say some companies out in Vegas, and I'll just leave you that imagination of which ones they didn't qualify. But it basically said in the CARES Act, any corporate entity, so it overrode the SBA rules to a certain extent. And so after that, it was great. We were in the game. Brokers were in the game. I know for a fact several of mortgage broker companies did get some of these loans, et cetera. So if you have not gotten a loan or you want to, and you think all the money's gone, don't worry about it. Just go to your local, there's content everywhere, and I think FAMP has it as well. Or if you need to, just go to your local bank, whether it's the big bulge banks like Chase and Wells and all those. Whoever you have a business relationship with, go to that bank. And if it's it's community banks are even better at this than the bigger ones, I think. So go to the bank, get in line, because not only is there was another, bill was just signed, I think 30-40 minutes ago. There's another $310 billion coming in for the Paycheck Protection Program, which means you can go get money for, I think, 2.5 months to cover your payroll. So just get in line, apply. You have to show them a few documents, and then you're good to go. And the other thing that was in there, and everybody doesn't, unless you're, I guess maybe a Washington part, but there is what they call it. There's another loan segment in there with $60 billion in it, and that's if you just Google this, it's EIDL and SBA. It's the Economic Injury Disaster Loan Emergency Advance out of the SBA, and that's where if you needed help covering your rent or a couple other things, that you can go there and apply for that. And so when you go talk to your lender, just tell them what you want the loan for. I'm sure they're going to ask it, but go ahead and do it, because here's what we've determined in Washington, and it's, I'm sure everybody's figured this out by now, is that these SBA loans, it was I forgot, 350 billion or 60 billion was the first one that ran out. And so what happens is there'll be another bill. There was a bill that was signed today, that's 310. And what happens is everybody that forgot to get some little thing they wanted in the last bill, they get it in that bill. And so so at the end of the day, there's going to be about 2 or 3 more of these bills for the COVID-19 bail, protection bill. And because the SBA folks have determined there's about $1.7 trillion in small business need, and so they haven't even approached that. So the bottom line is, don't be afraid. Go ask them for money if you need it. That's the quick update on the SBA loans. Now, another thing about Senator Rubio, he sent a letter, I think it was like 2 days ago, because what he was upset about is that the banks had their favored customers be able to get through the SBA loan gauntlet first,
right,
and did not sort of favor the smaller companies. And so he sent a letter and basically said, hey, I want to know, your matrix of who gets to go through the gauntlet over at SBA or at the banks. He named about, I think, 10 big banks, and just says, hey, I want to know your matrix of who got service first. And then if you had something like that, why did you have it? It's these kind of things that I think that will follow on. There are going to be hearings about who got all this money. You're even seeing it now in the presidential COVID-19 briefings. Is the schools, Harvard with $40 billion in endowment. These entities received it. What was happening is large hotels were applying for each individual hotels, and same with the private equity groups. They were applying for loans under each of the chain restaurants, and I won't mention any names, but so that individually they would go get the money. So that all these things are coming out, and And there's just going to be hearings after hearings on this for probably 9 or 12 months, or who knows how long. But if you do have any problem, and if some lender, if you're going to the bank and they say, "Oh no, you can't get a loan because of whatever reason," contact Gino and Linda, because they're, NAM has put together documents and shared it with the states about how that you can push back on lenders that say, "No, you don't qualify for the loan." So don't take no for an answer. Keep pushing and get your name on the list.
Yeah, that's
Okay,
good
Jim?
news. It's good to see that there's some progress that's been made and that they've adopted the new bill. That's absolutely phenomenal news, especially for the industry. And the favoritism you talked about in the industry it's amazing. Everything's very transparent in our day and age. There's hardly very much that gets unnoticed. So it's amazing that we still see this type of thing happen. But I'm glad it's brought attention to the problem and they're doing something to fix that. But yes, I agree. There's no reason not to apply for it if it's something that's needed. Get in line, like Roy said. That's the most important thing we have.
Well, NAM, we are starting to think through, like, why can't we just say, hey, what we want is the next round of this SBA can only go to companies with, sort of, the $1 million in revenue per year and down group, because that would really be the 2 million. Give us a low threshold, so that would really give us a good chance for real small mortgage broker companies to go in there and borrow money legitimately, and out of these SBA programs. So we are talking to. I spoke to Lacey Clay about it. He's a congressman from Missouri, and he's on the right committee. So, and I think we'll probably go into, again, Senator Rubio is spot on in the right committee. Being chair of that SBA committee is going to be very helpful to us.
Now, the being out there and you're talking to everybody, are there any new ideas, new topics coming out of Congress to help the mortgage and the real estate industry right now?
Yeah, sure. There's some of these things that you sort of get, you just sort of miss. One of them, and of course, I'll just go, the one we had, there's going to be a video coming out as I interviewed Congressman Lacey Clay, who has introduced a bill, HR 5720, which is basically going to ban trigger leads. And the rationale is that, hey, everybody is getting all the, you're going to try to refinance. There are $6 trillion in refinancing coming, and that's going to take, I don't know, probably 3 or 4 years for brokers and lenders to burrow through that. And so we thought this was a good time to bring up the issue that trigger leads are not good. They're confusing to the consumer. And we're going to, have a call to action on that, try to get more co-sponsors, other congressmen and senators to support that bill. So that's sort of one thing that we sort of looked at, worked on, and yeah, I think everybody saw this. But if somebody needed some cash up to $100,000, you can go to your IRA account and borrow that money without a penalty at all, and you have to, it's 3 years. I think there's no, oh yeah, you do have to pay interest. I forget what level of interest, but you have 3 years to pay that back without penalty. So that's kind of like a good sort of thing to put in your quiver if you have a client that needs a little help closing a loan. It's that. Those are just a few of the things. I think what there will be a focus on trying to get more money to really small business companies. But I think it's important for brokers to realize that, you really should need to go back to sort of like the essence of a mortgage broker is that you have multiple outlets for your loan. So it's not a good idea to have, rely on one lender that, you almost forget how to process a loan, because you just sort of upload a couple things and then they run, they finish everything else off, or they handle your advertisement or your connection to your consumer. it's very bad because, as you can see, right in situations like this, that some lenders are having a hard time, and so you need to have that diversity, which is the hallmark of being a mortgage broker. Let's see what so I just think that's important for brokers to realize that they really need to be brokers and have multiple outlets for their loan, because that's what when we come to Washington and talk about the brokerage industry, that's what is that's sort of impactful to the policymakers. And sure enough, another reason to join your state and local is that I all these lessons are coming back again from the mortgage meltdown in 2008 and 2009. Is the Dodd-Frank, we fought tooth and nail because there were a lot of people in Washington, D.C. that wanted to kill off the mortgage brokerage industry back then.
Yeah.
And so we went up and fought back. We had enough lobbying power and enough influence and calls to action to save your industry. And that's where, when crises come around like this, I think the independent mortgage bankers are learning, the lesson we learned back then is, you've got to be here all the time. You have to pay attention, because somebody will want to come after your market share. And so the only thing I would say is, like, please, when you get a call to action, don't think it doesn't mean anything. It's really easy. Most, the systems that we use today, I get 2 clicks and a couple more, and a button push, and you've already got an email or a fax going into your congressional member. So it's important for them to hear about you because they have so many things coming at them every day that if you don't keep your issue and your business model in front of them, that they're normal humans. They forget it too. So
absolutely.
Yeah.
I
The only thing I will add at the end, if we can go to questions, we have 15 minutes, is
Sure.
I was talking to another lobbyist for he goes, look, if you ever want to get into the microbrewery business, now's the time to do it, because at the end of June, 60% of the microbreweries are going to be out of business because of this virus, and because obviously you can't get there. That's what he was saying. He's like, hey, how would you like to be the microbrewery folks? 60% of them are going to be out of business in a month and a half. So yeah, every time you think you have it in a bad situation, think about the microbrewery.
That's a good point. It's I agree with everything you said, and being in the mortgage brokerage industry does give us quite an advantage, and you are right. Having all your eggs in one basket, especially in times like this, is very difficult. So it's and by no fault of our own, the industry has changed. There's been some more obstacles to getting that loan approved. If you look at the third-party services, you mentioned the 4506, we have the appraisal changes that came about, and there's been a lot of changes, and some of those have introduced some delays in financing. So there's no way around it. Some of the transactions that did take place had delays. So there's been some negativity around it, but in general, we're very fortunate that the market has not gone absolutely crazy. The rates are still at levels where there is still a lot of mortgage activity going on right now. So being part of our organizations, FAMP, NAMB, it really does give our members an advance, some more information about the pulse of the industry and what's going on. And we absolutely do need to act on those call to actions. They really are important and impactful, and really they're very easy to do with the technology that we have right now and the way we get those out to members. So it's really important to do that. I want to transition on to our questions. I know Linda's been accumulating the questions as we're going, so we're going to move into that right now. So I'll turn that over to you.
Perfect. Thank you very much, Gino, and thank you, Roy. Yes, we have a good list of questions. I'm kind of going through some of them because I believe there's some answers you've already been given. But the one question that has come up for 2 or 3 times is the link, the CFPB link. Could you repeat that, please? So our listeners can,
the
access
link,
that.
the video link.
Yes, the video link.
Yeah, that's one of those things where it's, the cfpb.gov, and then there's things after that. I don't have the exact link. If you give me a second, we can go to the next question. I'll try to find that link.
Okay.
But I know where it is. It's on the NAM website. Hold on for a second. I apologize.
All right. Can you look, and may I ask you another question at the same time?
Yes.
Okay. Okay. This person has a question as a potential buyer. Do you anticipate an increase in supply in home listings from people offloading Airbnbs, investment properties? And do you anticipate an adjustment in home prices?
Well, I'm certainly not an economist, but anecdotal evidence that I've received from some friends in New York is everybody in New York wants to sort of leave New York. They're trying to move up to Connecticut or wherever they could go to get away from this stuff, because it's just going to, so there's that little bit of evidence. Oh, shoot. So you have that sort of like little bit of information. And I guess the real question is, because I actually had this discussion with lobbyists in town, because that's all we have to do is figure out what happens next, is like, the real question is this: do you think, and this is especially great for Florida, do you think everybody is going to sell their house in Florida so they just have some, they're going to have some liquidity and go back north to wherever they originally came from and just try to retire there? Or are they going to sell their house up where they are and get, liquefy that money and come to Florida? My bet was that they all come to Florida, unfortunately. Or good for you, but if you live there and you don't like the traffic, not so much. So I think I'm betting on, people wanting to just to get to the warmer climate and stay there.
Right.
But that's my bet.
Okay, here's another question. What is the impact with refinances on service loans in default, but property has equity?
Say that again, I'm sorry.
What is the impact with refinances on service loans in default, but the property has equity?
I don't know. That's one of those where I think that's just the debate with, I don't know. I would, I know that everybody and their brother is trying to, I should say it like that. I know there are a lot of the GSEs, and they do not want that loan on their books. Right. And I know that if you're a lender with a big enough balance sheet, it depends on really how much equity, isn't it? So I think everybody's worried about a couple things going forward. Is how fast can you get 12 million people back to work and start this economy again? And we call it, it's the velocity of money. The velocity of money is it's as low as it ever has been, and that just means how many times you can spend $1 in a let's say a month. You go to the store here and there, and that dollar goes through quickly. That's what is the economists at the Fed are worried about the most, is how do you get the economy back up and running? So I really don't know how to answer that question, but I can tell you the thing that everybody's worried about here is how do you get the economy back up and have people start spending money so that right. circulates again and again and again.
Okay. All right, here's one more. Oh, we actually have a few more. Is anything being done to modify the current forbearance policy to help only the people that truly needed it, and not a policy for all, regardless of hardship?
Yeah, well, that discussion does come up, because now you got the moral hazard problem, which is like, well, I'm not really impacted by the virus that much, but heck, if I'll take 6 months of free, no payments for sure. The one thing we did, I don't think that the horse is out of the barn, as they say in Texas, is
Right.
once you have 5% of the population taking advantage of the CARES Act deferral, it's going to be hard for a politician to say, well, you know what, that's true. You got to prove something. I just think politically, members just don't have that kind of, that will to change it. So I don't think that's going to change.
Okay. Here's another maybe prediction question here. A lot of experts say market values will drop 25 to 30% in South Florida. What are your thoughts? And if the market will go through a short sell phase again, like 2008, 2010, and how will that affect financing?
Well, that's the whole question is like, what do people do with if you're talking about their second home scenario? That's the big question. The baby boomers are ready to retire? I mean, they're within 3 to 6 years to retire, and once your 401k or your whatever is taking a beating like it has, what's the best strategy for you to retire, which was probably their original intent. And that's where you have the folks saying, well, yeah, everybody's going to sell their Florida place and move, just consolidate back to where they were, maybe come down for a visit. I'm on the side of, I think people are going to, liquidate their let's call them the northern houses, snowbird houses, and sort of come down to Florida and hunker down, because there probably will be the virus is going to hit again in the fall, and then usually one more big hit in the spring of next year. So I just think my gut tells me people are like, let's just hurry up and figure out how to retire. So I think I think they're coming down. So stop them at the border. Okay. No.
Okay. All right. Why does the mortgage industry have a cap on broker compensation versus in any other industry in the U.S.?
Well, I mean, we've been fighting that since Dodd-Frank, and the simple answer is, or was back then, is, and I don't know if that whoever asked the question how long they've been in the business, but there was a problem. Let's be brutally honest about it. There was a problem early before Dodd-Frank of mortgage brokers getting a lot of payment from the consumer, whether that's up front or in the back end of the loan, the yield spread premium. Yes, that and the only solution was either destroy all the brokers or have a 3% cap. Now you do have one advantage in borrower paid, so that's one of the things. But I trust me, I remember this fight extremely well between the folks that were writing the Dodd-Frank bill and the people over at the Federal Reserve Board. The folks at the Federal Reserve Board wanted to kill off brokers completely.
Yeah.
And so we were able to fight that off. And one of the pieces was that you had to figure out a way for them to be capped so they can't shop the mortgage to get paid more money. That's just all there is to it. And that was the fix. And we keep going back to the Hill explaining that the cap doesn't work for certain levels of mortgages, and it needs to be adjusted. You need to either take out the lender payments to the mortgage broker company. That would help a little bit. But at the end of the day, that does remind me, there is some talk on the Hill to create a new sort of a low-income housing mortgage, probably to be run out of the FHA, and we're trying to talk to the folks designing that, and it may or may not get all the way through. So this is just one of those things where things that are being talked about in Washington is, how do you create a super nice loan package for, someone buying a house that's under $100,000, and that you have people in the market that are willing to work on that loan to get the consumer in it. So that's one piece. And so what we were trying to tell people, again, going back to the 3% cap, is you can't, as a mortgage broker, operate very well in the sub 100 loans at 3% cap. And so we're trying to at least inject that issue into the discussion.
All right, we're running out of. It does. Thank you, Roy. We do have we've got a lot of questions, but I'm going to just ask a couple more because I know we're at 4 minutes here before we end. But this question: have you contacted any minority house reps or leaders on how this is impacting the underserved or minority buyers?
Yes. I was just on a phone call with Lacey Clay. Lacey Clay is very interested in, the issues here, because he did introduce the trigger, the banning of trigger leads, and so that ability of us to discuss that sort of led into our discussion of other areas, and so he is very attuned to this area, and he's in the House Black Caucus. And so what happens is that the caucus meets by phone now. They used to meet in person, but they'll go and discuss these issues at those caucuses. So no, there's a lot of interaction with NAM and that caucus.
Okay, do you have time for a couple more?
I have time.
Okay, all right. Let me just get this one here. I'm trying to decipher because you're very popular here. So,
everybody likes to watch sausage made, don't they?
Okay. Is there any lobbying for a small application fee to be permitted? In other words, for brokers or lenders to charge, or brokers specifically to charge an application fee to the borrower?
Oh, in addition to the 3% cap sort of scenario, there's that piece and the,
and at time of application. Mm-hmm.
That was something that we had brought up to the CFPB, because NAM meets with the CFPB about every three months. And we bring this 3% problem up, trying to figure out ways to skin the cat, basically, of trying to say, they realize this is a problem. It's a very difficult way to get it written in regulation. But we brought that up to them, and we'll bring it up to them again because it's a good idea.
Okay, all right. Last question, and we have many others. So what we're going to try to do is do a report of these and maybe follow up with you, Roy, to get answers. And we'll either post those on our website, or we'll find a way to get these answers out to everyone. But as we're entering into, as we are in the middle, rather, of an election year here, the impact of the mortgage industry, of who remains in office or who may win the election. What do you think that's ultimately going to do with the mortgage industry either way? Any predictions or thoughts on that?
I hate to, upset like half of the audience and make the other half happy and all that, but this virus thing, changes. I mean, it changes this game so much. It's hard to figure out how this all ends up in the fall. I would say this: if the House picks up let's try to impeach Trump again for whatever reason, he didn't handle the virus well enough, or this or that, I think that ultimately damages Nancy Pelosi and the Democrats. So if they do that, then Trump I think he's going to have an easy walk. But at the end of the day, I think that if the conservatives keep control, let's say, that you're going to have some benefits, but at the same time, you like the government, everybody loves government programs that helps you make money until until somebody's a free market person like Mark Calabria over at FHFA. He's a free market libertarian. And once something comes out and it's totally, oh no, it's a total free market, you may not like it. So, or, it would be such that what we usually always worry about is Washington trying to throw the mortgage business completely inside the big banks? Are they trying to do that? It certainly looks like it a little bit. So you got to fight back against that. Washington is one of those things where no one's going to come out and say, oh yeah, we're trying to throw everything we can back into the banks so they can make more money. You just have to read the tea leaves and look at the narrative of what's going on. So you have to basically want to support things that help the mortgage market, but at the same time you don't want someone to take your market share or put you out of business. I don't know if that answered your question.
Well, that was a very politically correct answer, so good job. But one last question, Roy, if you do not mind, because this has come up, I think, 3 or 4 times from different viewers here, but is the PPP, the SBA loan, available for independent contract loan officers?
Oh, hey, I'm glad you mentioned that. I apologize. I had it on my notes and I forgot to mention it. There is a new program. I was just, because you got to read these, so when the reporters get these things, they just do the high tops, right? So you really have to read the whole bill. And that there is a new program if you are if you're in the gig economy and you do 1099s, and I forgot give me a second, I'll find the name of this thing. It's a new sort of program. It's an unemployment program. It's nothing that's going to be run through. It's not going to be, I don't believe, run through the SBA. It's just basically it's called the Pandemic Unemployment. I didn't get the last part. It's a pandemic unemployment asset or something, assistance. That's what it was. Pandemic Unemployment Assistance Program. So if you just Google that, or I can try to get the info to Gino and Linda. But if you have a 1099 or you're, anybody that's in the gig economy and they just have 5 jobs to make it, or you're a processor and you're tired, or whatever the situation is, there should be another program being rolled out to help that person.
Okay, great. I'm glad we did. We were able to get this, squeeze that question in. That's a great information and great answer. Thank you, Roy.
Yeah, and the CFPB link, I just had to send. I'll send it to you guys because it's just one of those long YouTube links. So I wouldn't want to bother.
Well, exactly. So what we'll do, everyone that's on the call, we send out, again, as Gino mentioned at the beginning, a recording of this. We will also try to get these various links and attach them, or at least reference those in the email for you. But this has been fabulous, guys. It was very informative, and we had a record number of people on the call and a record number of registrations. So we can't thank you enough, and we thank everyone that was on the call here and on the webinar. And Gino, would you like to say some final words?
Yeah, thank you, Roy. I really appreciate you spending the time with us here today. We did get the link up. It went out in the chat box, so the link for that video is there. So you can go ahead and make note of that, copy that down. We do have the COVID-19 section on our website, on the FAMP website, which is up on the screen right now. So you can get a lot of the information we talked about today is up there in that section. You also can join FAMP and get access to the other webinars that we've had over the last couple of weeks. But I really got to tell you how much I enjoy listening to you, Roy. You really do a great job of representing the mortgage industry and making sure our message gets across to the right people, so that we can have change and protection that is specific to our industry. So I really got to thank you for what you do. And I know you're busy, so spending time with us today was very valuable. Thank you very, very much. And thank you everyone that was on this call. We're going to be having more of these, so look forward to them, and send any ideas you have up to FAMP to either Linda or myself, and we'll try to address those in the upcoming weeks. But look forward to a lot more of stuff like this coming your way.
Well,
Thank you, everyone.
It was a pleasure being on the call, and call on me anytime.
Thank you, Roy.
Absolutely.
PJ, no.
All right.
All right.
Have a great
Good
day,
afternoon,
everyone.
Bye-bye.